Canada's banks are the front line of the delivery of much of the aid that's being offered to both Canadians and businesses. Meanwhile, their own businesses are severely impacted by the changing fortunes of the Canadian economy because of COVID-19. So how are they positioned? We welcome now Jeremy Rudin. He is the superintendent at the Office of the Superintendent of Financial Institutions. Thank you very much for being with us.
Thank you. Thank you for having me. I'm really pleased to have the opportunity to speak with you and with your viewers. I know the Canadians have a lot of concerns these days. They have concerns about their health and the health of people around them. They have concerns about the economy. So I'm happy to have the opportunity to speak to you and to say that the financial system and the stability of the financial system, it's one less thing to worry about now. Our financial system is very resilient. It's very well prepared for what we're going through.
And you've taken steps to make it even more so. Just describe what we've done on the stability side, just in terms of making sure the banks have the kind of the capitalization they need and that you're kind of giving them a little more flexibility.
Sure, I'd be glad to. So on March 13th, we instructed all of the banks and insurance companies that we supervise not to increase their dividends and to stop buying back shares. And that helps to protect their capitalization, so the amount of loss-absorbing capacity that they have for the times ahead. But that's part of our broader approach to capitalization, which has two main parts. The first is that since the financial crisis, we've substantially increased the regulatory minimums for capital, strengthened them across both banks and insurance companies. But on top of that, we've been building up buffers above that, buffers that are built up in good times precisely so that we can release them when the economy goes through a difficult period. And that creates room for banks and for insurers as well to continue to make loans, indeed to expand their loans, but also to continue to pay their dividends and therefore provide income to Canadians.
We have heard from the banks. They are obviously dealing with a massive flow of requests. And as we've seen, this huge record number of mortgage deferrals. Some of those mortgages, of course, ultimately, through any recession, might have defaulted. How are we tracking the risk in the system while we're kind of smoothing it over for this period of time?
Well, all of the banks will be obliged to keep track of all of the deferrals that they've made and to monitor the payments that they come from their borrowers. And they'll also be obliged to set aside appropriate provisions, loan loss provisions, that will definitely have to increase as a result of what the economy is going through.
So what is it that we hope most that the banks can achieve here? They're obviously been tasked with basically distributing some funds that they're not originating, right? They're now kind of backstopping and managing a loan process for other organizations, including EDC and BDC, and possibly, I would imagine, even CRA ultimately. But just in terms of what the banks might need in addition to what they already have, is there any other capacity that you're going to have to let them have?
Well, certainly, we're monitoring the situation closely, and we stand ready to take further steps. For example, on the capital side, we released about half of the stability buffer that we've imposed on the major banks, and we're monitoring that. We're prepared to release some or all of what remains, if need be. And the broader government is providing a lot of support to banks in order to make sure that they have the liquidity, so the ready cash, so that they can do on-lending, whether it's through ADC, BDC programs or other programs.
What other regulatory changes might come? If you mentioned some of them, but are you kind of in constant touch about other changes that might be required?
Indeed. So last Friday, we put out a pretty comprehensive list of the regulatory changes that we've made already. Supply banks, insurance, also to the pension plans that are in our jurisdiction. And we'll be providing a frequently asked question site to clarify any things about that need to be clarified. But certainly we're in constant dialogue with all of the industries that we supervise, and we're already working on things that we may need to roll out in the near future.
And I mean, underlying all of these assumptions must be, of course, some kind of planning about the length of the recession, the depth of the recession, understanding that it's hard to forecast any of that given the degree of uncertainty. What are some of your working assumptions about how bad this might get?
Well, we're in the prevention business. We're the prudential regulator. And so what's important to us is what we call the severe yet plausible scenarios. And that's what the institutions need to be ready for. And what the severe yet plausible scenarios are continue to evolve. We get more information about that from day to day. And we're continuing to look at our own approach to make sure that it's keeping up with those, the evolution of that thinking. So one of the things that we are definitely looking at, which we've already mentioned, is that we'll look at the amount of capital buffer that we have kept in reserve, and we stand ready to release that if we think that that'll be necessary.
All right. We appreciate your time today. Jeremy Rudin is the superintendent at the Office of the Superintendent of Financial Institutions.